Good morning. Today's session is currency convertibility. Convertibility means the ability of residents as well as non-residents for converting the domestic currency into foreign currency for doing some kind of international transactions. There are no restrictions, there are no limit for converting the domestic currency into foreign currency for doing any international transactions. That is known as currency convertibility. So basically there are three types of convertibility. First one is known as fully convertible currency, which means that there are no restrictions, there are no limit for converting the domestic currency into foreign currency and foreign currency into domestic currency for doing the international transactions. Such kind of currencies are known as fully convertible currency. And second one is known as partially convertible currency. There are certain restrictions or limit put forward by the government on converting the domestic currency into foreign currency and foreign currency into domestic currency for doing some international transactions. That is known as partially convertible currency. And third one is known as non-convertible currency. The currencies which are completely blocked in the foreign exchange market but traded in the domestic market, such kind of currencies are known as blocked currencies and non-convertible currencies. So based on the currency convertibility, there are three types of currencies. One is known as fully convertible currency and no restrictions on buying and selling of the currencies traded in the market. That is known as fully convertible currency. And second one is partially convertible currency. There are certain restrictions on buying and selling of the currencies on certain accounts, transactions, such are actually known as partially convertible currency. And third one is non-convertible currency. Restrictions on buying and selling of the currencies that traded in the forex market. That is known as blocked currency or non-convertible currency. You know that why the countries are actually blocking the currency. There are some reasons for that. Basically, these are the currencies that traded in the domestic transaction but not traded in the foreign exchange market. Why the government put forward certain restrictions? The inflation rate of those particular countries will be at very high level. That's why these countries are trying to control their inflation rate. They restrict these currencies to be traded in the foreign exchange market. Especially one example you can take that Cuban peso is one of the best examples for that. And Barbados dollar is also another example. Both of these currencies are not traded in the foreign exchange market but traded in the domestic market. Let's look into the types of convertibility. The first one is known as current account convertibility. Current account transactions, as you all know, that export of goods and services, import of goods and services, unilateral transfers like gift, donation, subsidies received from abroad and given to foreigners. All these transactions are coming under current account. So the current account convertibility is simply known as complete freedom in respect of converting the domestic currency into foreign currency and foreign currency into domestic currency for doing all these kind of transactions related to the current account. This is known as current account convertibility. In India, the current account is fully convertible in nature. Why it is known as fully convertible? Indians are allowed to buy the goods and services from abroad, and Indians are allowed to convert their domestic currency into foreign currency for buying the goods and services from foreign market. So it's fully convertible in nature. At the same time, Indians are selling the products and they are getting some foreign currencies. These foreign currencies can be converted into Indian rupees at the market determined rate. So India's current account is fully convertible. There are no restrictions put forward by the government on buying and selling the goods from abroad. You know that these are the current account transactions: export of goods and services, invisible goods and services exports, and pension payments. All these are the examples for current account. And capital account transactions are basically related to the movement of capital, inflow of capital and outflow of capital, which is related to three items basically. And first one is known as foreign direct investment. As you all know that what is FDI. And foreigners are investing in setting up the facilities here and have got some control over the affairs of this business. Such kind of investments are known as foreign direct investments. And second one is portfolio investments. Foreigners are buying the Indian company shares from Indian stock market, and that is known as portfolio investments. And other investments, borrowing and lending from abroad, that is also one type of capital account transactions. In India, what is actually known as capital account convertibility? It's known as it is the freedom for converting the local assets into foreign financial assets and foreign financial assets into local assets at the market determined exchange rate, that is known as capital account convertibility. In other words, Indians can buy the assets from foreign countries by way of converting Indian currency into foreign currency, that is known as capital account convertibility. But in India, the capital account is not fully convertible in nature. Why? Capital account is not fully convertible due to several reasons. There are certain restrictions put forward by the government on various aspects. There are certain restrictions on the companies which can borrow from abroad. And there are certain restrictions on the foreigners who can come and invest in Indian market. There are again the restrictions put forward by the government on the FIA who can hold the shares in the Indian market for a long period of time. Lot of restrictions are put forward by the government on the capital account transactions. But individuals cannot borrow the money from overseas to buy the homes in India. These are the restrictions in the capital account. So capital account is not fully convertible in nature. Capital account is partially convertible in nature. Why it is partially convertible? Partially convertible is known as restrictions put forward by the government on converting the domestic currency into foreign currency for doing some kind of transactions related to the capital account. That is known as capital account restrictions. It is known as partially convertibility currencies. Up to 1991, there was control on the capital account and current account transactions. But after 1991, IMF put forward certain rules and India accepted all the rules for the currency reforms. And capital account convertibility was introduced in the year 1994. And there was a committee formed that is known as Tarapur Committee. Tarapur Committee suggested a lot of recommendations to introduce this capital account convertibility in India due to two reasons. First reason is financial mobility, which is easily possible in India by way of introducing this. And second one is you can distribute the international capital from Britain, capital from US, capital from all other countries which can be introduced in Indian market, which is possible by way of implementing this CAC, capital account convertibility. But only under some conditions only we can introduce this capital account convertibility. India must be able to reduce the fiscal deficit. India must be able to reduce the inflation rate, and cash reserve ratio should be reduced to a very low level. Only under these conditions, India can introduce this concept, capital account convertibility. In simple words, what is capital account convertibility? No restrictions for buying and selling the assets from abroad by way of converting the domestic currency into foreign currency. And foreigners can come and invest any amount of money in Indian market. So no restrictions to the foreigners for buying and selling the assets from India. That is known as capital account convertibility. Then what happens usually, the exchange rates will fluctuate above a particular level. So the government must put forward certain kind of bandwidths like 5%. After the 5% bandwidth, when the currencies are fluctuating, then the government must take some mechanisms to control the exchange rate movements which is needed in the market. That is the suggestion put forward by Tarapur Committee for introducing this capital account convertibility in the forex market. So all these are the types of convertibility. To conclude, you know that there are three types of currencies. One is fully convertible currency. That is known as there are no restrictions for buying and selling the currencies for traded in the forex market. That is known as fully convertible currency. And second one is partially convertible currency. There are certain restrictions put forward on buying and selling the currencies for doing certain type of transactions. That is known as partially convertible currency. And third one is blocked currency. And complete restrictions on buying and selling of the currencies in the forex market. Such kind of currencies are known as blocked currencies. These are the three types of currencies. And two types of convertibility: fully convertibility, partially convertibility, and this one, last one, is blocked. These are currencies. And two types of convertibilities are there: First one is known as current account convertibility, and second one is capital account convertibility. In India, current account is fully convertible. No restrictions on buying and selling of goods and services. But in India, capital account convertibility, there are certain restrictions, and Indians are not allowed to buy and sell their assets very freely from the foreign market. The reason is it is some restrictions put forward by the government. So I think you understood both convertibilities, current account and capital account convertibility. Thank you.